Okay, should be live now. Had a little bit of technical difficulties, but welcome back and happy Wednesday. Today we are going to be going over your questions live as always. We do this every Wednesday at 3 p.m. Pacific Standard Time, and we are starting with a comment from Canada. And they asked specifically, what is the A to Z on buying an actual piece of real estate? So once you find a piece of property, that's exciting. However, how do you actually buy it? Once you've reached out to the owner, you want to send in an offer. This is where you get your broker involved. And what they're going to do is they're going to put together a PSA. This is a purchase and sale agreement. And your purchase and sale agreement is going to outline the terms of your offer, and then it will have specific addenda, such as contingencies. One main contingency could be a feasibility. And now this is going to lead into where we go next. But when you send over your offer, you outline contingencies. Typically, you're going to have to put down some type of deposit. That's going to be with a title and escrow company. And what you do is once you send over your deposit for the contract, you have to follow what you signed for. This is where having a really good real estate agent comes into play. We've got a really solid real estate agent. His name is Eric. He works at Foundation Group in Seattle. He puts together our offers. You're welcome to reach out to him. But when you find your good agent, you send over your PSA, your purchase and sale agreement. As soon as everybody signs around, the buyer signs, which is you, and then the seller signs, whoever that is in your specific deal, you are now mutual acceptance. That is where you are under contract. This is where wholesalers get excited and try and sell their contract to someone else with an and or a signs. But when you're buying real estate, you have to follow the timeline spelled out in your contract. So typically, you're going to have an inspection contingency, or what I like better is a feasibility contingency. I get to look at the due diligence of the transaction. And if it's a small deal, I'm going to put a 10-day window. If it's a big deal, I'm putting typically 30 days, 21 to 30. So I get 3 to 4 weeks. And what I'm looking for in that due diligence when you're going A to Z and buying a piece of real estate, your due diligence can make or break the smooth transition from the current owner to you. So I'm looking for number one, I want to see valid leases or rent roll. I want to see estoppel letters, which is where the tenant signs off saying that this is my rent, this is my security deposit, this is when I moved in. The reason I want the tenant to sign off is the owner can lie. I want to see what the tenant thinks the deposits are. So you're going through this, you want to see bank statements, you're going to do your due diligence. As soon as you get past that due diligence period, then you have typically your finance period. If you're doing seller financing, that's really easy. You get an attorney to draw up a promissory note, a deed of trust, and then you can sign off of that at escrow or with your attorney, and you guys can close that deal and it gets recorded. But really the base elements of start to finish on a transaction is you send in the offer, you go to mutual acceptance, and then you start following the timelines. The first one is typically your inspection, where you can have an inspector go in. You can do the financial due diligence. You're going to be clearing title, making sure you get free and clear title during all of this process, which just means there's no loans that you're inheriting that you don't know about. As you progress down that timeline as well, you either have your conventional loan that you're going to be getting going, where you have an appraisal. They're going to go out, look at the units, look at the property, put together a value and an assessment for the bank. If you do it the way we do it, you don't have that. You have a promissory note and a deed of trust that's drafted up by the attorney just with the seller instead of with that bank. And once all the docs are prepped, if you've done your due diligence, you have the financing lined up, whether it's private seller financing or conventional or some other means of financing. As soon as docs are prepped, you sign at escrow, you sign with the attorney, and you are all set to go. I see some people jumping in. If you have questions in the meantime, feel free to put them in the chat. It is just me today. Christian's over in Moses Lake. He's touring the portfolio and checking out some of the contractor projects. Now, someone else asked, Josh, what were the terms of the HELOC you got? I'm finding getting a HELOC on a non-primary residence is tricky. So we did an expensive HELOC, and it wasn't through a traditional bank. It was also private money. So it was a second mortgage with a private investor, and our typical rate on those are around 12%, sometimes as high as 2 to 3 points up front, meaning that if I borrowed $100,000, 2 to 3 points means I'd have a $2 to $3,000 fee just to get the loan, and then I have to make my monthly payments. It can get very expensive, but when you're looking at your deal, Josh, it comes down to, is it more expensive not to buy it? And if the answer is yes, then we're going to opt to buy it. All right, from Deliver My Heart in the chat, what is the best way to approach your local banks for a business line of credit? Well, that's going to depend. But what I like to do is set up a depository relationship. So if you are wanting to work with a local, smaller credit union and you've got a business, for example, Christian and I have, well, we used to share the property management company. Then I let him trade to Sixplex for my ownership in that. But he's got that business. We share the consulting company, which is multifamilystrategy.com. And so we have some revenue on those companies. PM was really easy because we charged ourselves PM fees. So that started to build revenue. But if you have a little bit of revenue in your business, you go get set up with whichever bank you want to build that relationship with, and you have all of your revenue start cycling through them. And as they see that you're a credible business person and you have money coming in, they're going to be able to see unobstructed books because they have your money on their books. That is the best way I found to start building that relationship is you do business with them. You bring money to them because as soon as you put money in their accounts, they're going to lend it out. They're going to start making more money, and that will start to further that relationship to where you can ask for a business line of credit. Found it is much easier to get a loan on a business once you've been in business for 2 years. It's not impossible to get it on something where you've been in it for a month or two. Typically, on the shorter deals, what we found is that a 0% interest credit card where you get 18 months at 0%, 12 months, it's a promotional period at 0% interest. That has been the easiest way to do it up front, where it's just a smaller exposure to that bank or credit union. But, again, you gotta be able to make sure your business can support it. Just because you can doesn't mean you should, and just because you can get the money doesn't mean you should borrow for it. So make sure your business has the revenue to support it, and then just share that with them, and you can start building that relationship. From Chunk Samson, I'm about to sign a deal for creative finance. I'm a higher income earner and using it mostly for taxes. Creative finance is the perfect way to gain equity in that situation, don't you think? Well, depends. If it's a value add opportunity, then you gotta figure out how do you buy it and how do you never lose it. And if it's a stable opportunity, you have to figure out the same two things. How do you buy it and how do you never lose it? If you just wanna buy it for the tax purposes, it's the same thing. How do you buy it? How do you never lose it? There's a simple trend here. It doesn't matter how much money you make. You can make 10 bucks an hour, 8 bucks an hour, or you can make $8,000 an hour. I've met people that do both and more than that. And if you're buying it just for taxes, you should still make sure that it cash flows. You'll probably do your advanced schedule for the depreciation and get your write-offs. But the financing, whether it's creative or conventional, is just the debt product. That is a means to how do you buy it. What you do need to figure out though is how do you never lose it. So I wouldn't look at the debt as the way to gain equity. I would look at the debt as a means to acquire the asset. You have to do your math to make sure you can actually hold on to that. If you want a really good way to get write-offs on your taxes and on your income, you can lose a whole bunch of real estate, but that's a very poor idea. So I would look at the creative finance as a means to get in, but don't get so creative that it's not repeatable. Because if it's not repeatable, it's not worth anything. From Samuel, when you raise the down payment for a deal as debt, would I give them some of the monthly cash flow or wait till I cash them out through a refinance? So that depends. If it is as debt, then you're going to be signing typically as just a standard. It's called a promissory note, or it's a promise to pay. And your promise to pay is going to outline the loan agreement. Whatever you and the lender agree to, there's going to be some sort of loan agreement. It's usually a promissory note, but not always. And that is going to just outline you're paying them X amount, uh, X periods per year, or however many times you pay them. Typically, it's monthly, but it doesn't have to be. It could also be on accrual. But that will outline everything. If they're a partner, then that's going to depend on your operating agreement, which just outlines how the company or your partnership is going to operate cash flows and the write-offs and the obligations. So, depends how you structure it, but if it is debt, then you're gonna have some sort of loan agreement, and you're gonna have to live and die by that loan agreement. Whenever we raise money on a down payment as debt, we do make monthly payments. From Kevin, what are your thoughts on calling a seller's agent and telling them they can represent you for a double commission to incentivize them? I like my own representation. It doesn't always be like that, or it's not always like that. We're doing a deal in Walla Walla right now where there's one agent involved, but he's our agent, and then he's helping out with the seller, connecting them with their attorney. So, absolutely, they can get double commission, but usually that's not what's going to get these great deals put together. I like my own representation, whether it's an attorney or my own representative. I like to work with Eric out of Seattle, and he hasn't let me down. So I don't want to let someone else give me a deal just because they're getting paid double. I'd rather work with Eric and find a way to make that work. Do you offer a seller financing agreement under civil law? Could you rephrase that in a different way, Bon John? I'm not quite sure. I haven't read that before, looked into that before, but if you could rephrase that, that would be great. From Marco, if I find deals, can I send them to you? If so, what would those steps look like? Absolutely. I mean, there's tons of deals. There's lots of good ones, lots of bad ones, and you can absolutely bring them here. If someone has a deal, we've gone over these live many times. We can go over the numbers live. We can go over the address live, and what we think about the location. But you can just bring them to these calls, and absolutely willing to go through those in real time. From Bovini, would you do this deal? $700,000 single family, 2.75% sub 2 deal for the 336 loan, 160,000 down payment, seller finance the rest at 0%, both debts due in 5 years, and the rent's for 3,500. Total monthly expenses is 31. I would not do that deal. Number 1, there's a lot of moving parts. 2, if you're putting down 160,000 and your total income is 35 and your total expenses is 31, I'm gonna assume that includes the mortgage payments. You're making $400 a month, $4,800 a year, which is not a very great return on $160,000. I'm gonna should do that on the calculator really quick, but 4,800 on 160 plus your closing costs, I mean, that's a 3% ROI. I'm not super excited about 3% cash on cash. If you love the house and you see you and your family or just you living there someday, you can absolutely go for it. But that's a lot of steps to make 3% when you can do a lot less complicated deals and earn quite a bit. Also, we've got 21 people in the chat and 1 like. If you wouldn't mind hitting the like button, that would be awesome. From Thinking AI, sellers selling a fourplex for 950,000. The rents are around $1,000. Market is 1,700. Current expenses, insurance, taxes are 21,000 a year. The net income is 54,000. Debt service would bring this under though. Okay, so you have a fourplex, and the net income is $54,000, which is 4,500 a month. What you're saying to me is that the rents are all around 1,000, which means it's bringing in 4,000 a month, yet the net income is 4,500. So I'm gonna assume it's pro forma. If you got the market rent, which is $1,700 on 4 units, that's $6,800 per month, and that's gonna be like 82,400 bucks or somewhere in there. So we got about 82,000 a year. So, yeah, I'm not sure that doesn't quite zero out on your numbers. Because if you have 21,000 a year in expenses from the even if it was 80,000, you're still at 60K net income. If the net income is not high enough to service the debt, one way you can increase your cash flow is to get cheaper money, but, that would be through private funds, and typically the cheapest private funds are seller financed. So, you gotta reduce that cost to capital. I'd also solidify those numbers because as of right now, 54K NOI on a $4,000 a month or $48,000 a year gross income is impossible. For my Apple ID, Texas is competitive, but I don't know where else to look. If you had to look outside your local market to buy, what three cities would you consider for seller finance multifamily opportunities? Texas is competitive. I've got a couple buddies who are buying in Texas and they're buying at seller finance. There are people that own real estate and cash in every single market in the United States. If I was starting over, then I would most definitely choose a tertiary market. Um, I'm looking at Walla Walla right now, which is about 5 hour, 6 hour drive from where I live. So that's a ways away. I'd look all throughout Idaho. I mean, you can do this anywhere. I'm in Tennessee as we speak right now. So I'd be open to here. I have some buddies who are killing it here and making multiple six figures a month in the space over here. So they're absolutely crushing it. But you can do this in any market. I would try and find tertiary markets that are an hour and a half, 2 hours out of the main cities in landlord-friendly states, because 'cause I've never bought in a landlord-friendly state. It'd be cool to see how that plays out. But tertiary market, because the further out it is, less players there are. Like you're mentioning in Texas, it's very competitive. If you can find a non-competitive space, that helps you in the beginning when you don't have any money, become the most logical buyer. It's very difficult to be the most logical buyer in a DFW. What's the best way to get in contact? You can shoot us a message on Instagram. Christian's Instagram is just Christian Osgood. It's his name. He has a less common name, and mine is at doing Cody things because I'm always doing Cody things. From Dylan, how do I present to a seller a good contract? Do you structure your creative finance deal before presenting it, or do you work on the contract with the seller? So if the contract that you're referring to is the purchase and sale agreement, that's going to be a state standard form that your agent can put together. I would not try and find a boilerplate. That would not be a good idea to find that off of the internet. So I would just try and get one from your agent. And once you do that, then you're all set. If you're talking about the promissory note and the deed of trust, then you can have your attorney draft that up during escrow. And if you're in an attorney state, then you can work with them. How do I present to a seller a good? Oh wait, no, I just read that. From Bobini, okay, thank you. What are your thoughts and advice on subject to deals overall? I'm not a fan. I don't like adding steps. I just think that is a poor business model. That's why our number one rule on the channel is don't add steps, and that keeps unnecessary people involved in the transaction. You can absolutely get complicated, but to the extent that you can keep things simple, they become repeatable. So, subject to is a clause in a real estate contract, and that adds steps that we don't like. Okay, let's see. Hello, what are your thoughts on investing in the Iranian sand market? I don't have any thoughts, but it's probably better than buying digital salmon. That is my only thought there. From Kevin O'Neill, hey Cody, what is a common debt structure for borrowing private money for a down payment? Well, what I like to do is second lien. So you got your first lien, which is your mortgage, and liens are just loans. It's how you're backing it against the real estate. And then the second lien would be for the money I'm borrowing for that down payment. So that would be my standard, but it completely depends. You can back it with what you own on your assets. So you can back it with a company if you have a company. You can back it with real estate if you have real estate, or you can back it with a subject asset. Those are the typical forms. How did you determine your county? I know it's pretty far, um, to get to Grant County from Tacoma. Well, when it came down to picking it, that was the biggest opportunity and the best location that I could put together. That was it. You should buy the biggest deal, and I got this from Grant when I met with him, but you should buy the biggest deal in the best location that you can afford to get into. And afford is really where you find the money. There's two types of money: debt and equity. So I bought my first deal 100% debt, but it was a 12plex. If I wanted to buy the same exact 12plex where I grew up, it would have cost twice the price. And I overpaid for my first deal, which is fine. It was long-term fixed rate debt, and it cash flowed with margin, so it hit the rules. But biggest deal, best location you can, and that was Grant County. It was on the MLS, and so that was just a slam dunk, easy way to do it. But it was also on the market on the MLS for 551 days. Anybody could have bought that deal. So I just looked up owner financing on the MLS after the 22 unit. I've talked about this on the channel before. Off market seller finance deal that was going to make a lot of money. That fell apart for someone else's client. I looked up seller financing on the MLS and found that one. And I wasn't looking at any specific county. It was there. In Tennessee, you're talking like Mo I don't even know how to pronounce that. Murfreesboro and cities surrounding Nashville. So I am in Clarksville. I'm not in Nashville. I was just in Nashville dropping off my buddy at the airport. He wanted to come hang out for a day. So he flew in and we hung out and now he left. But uh, yeah, I am in Clarksville. I think Clarksville is north an hour, but it might be south. I think it's north. How did you quote your renovation costs like a kitchen and what's your typical prices? So when I'm turning units now, I'm spending typically 10 to 15,000. When I was doing it originally, I was spending 10 to 15 hours. And so I was going in and doing it myself. I emphasized saving money over time. Today, the time is worth a lot more than the money. And my original mentor at the time, who's no longer around, he said that, Cody, you're not a plumber. And so I had to hear that a couple of times, but after hearing it enough, I started just budgeting in the real estate just to pay someone else. It tanked my cash flow a bit, but it was absolutely worth it. So if I'm doing the turns now, ten to $15,000, and that is my standard pricing. From city trips, no sellers seem to want to do long-term fixed rate debt, or they want to mass it down. Absolutely, everybody wants everything. Problem is, I don't have everything, nor do I ever plan on having everything. So I want to give them as much as I can, but I acknowledge and they understand that I can't do everything. So if you can't get super long term, maybe you can't do 10 years. Maybe you can do 5 years, but you can pay to extend it another 5 years. It's not a free ride at that point. So shorter term, you maybe do a 5-year debt product, but you fix the rate no matter how long it is. That is so important. You can have adjustments. So maybe you do 5 years at 5%, and then you do another 5 years at 6%. You can absolutely change it, but you don't want it to be tied to anything where it could go way up or way down because you don't want variables when it comes to when you're borrowing money. And if they want a really large down payment, maybe they want 30%, say, absolutely. I'm good for 30%. This is what we're gonna do. I'll give you 10% in year 1, I'll give you 10% in year 3, and 10% in year 5. Just break it out. It's not a matter of if it's an issue, it's how can we make it happen? You don't want a problem, you want a solution. So when you have a problem, don't focus on that, focus on what's the logical answer that gets everybody what they want. We can do 30%, we just have to break it out a couple of years, and then you structure the real estate where it can save up most of the money, if not all of it, to make those additional down payments. All right. For my Apple ID, Cody's looking more tan. I'm trying. It might also be this lighting, but I have more color than I did 2 months ago. Appreciate it. For Kevin, what are your creative finance options if the seller has outstanding mortgage? You can assume the mortgage and have a contract for the rest, or you can have the down payment be enough to knock out the mortgage, or you can have them move their mortgage to another property that they own. Those are the standard options. On any of your renovations costs, when you borrow the down payment for equity, okay, so you have an equity partner, how do you still finance the rental costs? Let's say after refinancing your equity partners out. Okay, so if you're financing rental costs, you do have to pay for your bills with money, and it does have to come from somewhere. When I got started, I did it over time. I got an inspection. I think it cost 1,700 bucks. It was somewhere in there. And the property was in really good condition. Didn't need a whole lot. So I went in and saved all the cash flow, which I believe is super important, especially when you're getting started. Save up 100% of that cash flow. And then every time I had an expense, I could just pay for it out of that account. On bigger deals, I've taken out a 0% interest 18-month credit card, but I've made sure that I can get the real estate to pay it off with plenty of time before it's due. That's so important. People borrow money because it's cheap and then don't do a risk analysis. Nobody adjusts for risk on how likely are you able to pay everything and then knock out these debts. When you borrow money, you do have to pay it back. And so if I don't have the money to renovate it myself, I will borrow it, but it'll be on a longer term product where the cash flow can pay it off. I turn my upfront cash problem into a cash flow problem and I let the real estate take care of that. If you're bringing on a partner, you could also just negotiate where they bring in more money in the beginning. It's difficult in the beginning. The more deals you do, the easier it gets. What's the minimum number of units you recommend? Well, we have criteria for buying real estate. You have to solve for two questions. How do you buy it, which is lining up your deal with the thing you want to buy, and then the money, which is your debt and equity. After that, you have to solve for how do you never lose it, which is long-term fixed rate debt, which eventually pays itself off, and then cash flow and margin. And if you can line those things up, that helps reduce your risk of losing the real estate. I don't care if it's a house. I wouldn't buy a house for a rental, but you can. I know a lot of people that do. And I met a gal who's in her late 50s, early 60s. She's been playing the game for a while, but she's got 1,000 houses. Her philosophy, I just met with her in New York, was she wants to own a bunch of real estate, but she wants to own the dirt and then just have things on top of it that pay for the dirt. So that's why she does the house thing instead of apartments. She wants a whole bunch of plots of land. So she makes a lot of money on 1,000 houses. There's no minimum amount of units, but you do have to risk adjust and say, okay, do I make enough income on these houses that I'm buying to warrant owning them? And if the answer is no, then how do you fix that? You buy a bunch of them. But how do you buy it? How do you never lose it? If you can solve those things, to the best of your ability, risk adjusted, you can always lose stuff, but we say that because you should mitigate that risk as much as possible with long-term fixed rate debt, cash flow with margin. If you can just figure that out, even if it's on a rental house, if you cash flow 500 bucks a month, and you buy another one, now you're at 1,000 bucks a month. You buy two more, now you're at 2,000. It's hard to go broke if you just keep increasing your cash flow in excess of your expenses. So I would not limit yourself on that unit count. I like to be above 10. Today, we don't really want to touch anything that's under 20. We would like to be above 40, but if we have a great 20 unit or a great 10 unit, still buy it. You prepare several documents and stipulations like a payment schedule and requests such as zero down for the first year on seller financing. What other strategies are there to get more vendor take back deals? Well, you just got to keep it simple. And if you can keep things simple when you're talking to people, and you can just position yourself as the most logical buyer, that is the key that people don't get. Whenever I'm putting together a deal, I become the most logical buyer regardless of what I'm buying. And to the extent that you can do that, which just means that you're keeping it simple, you're you're not trying to talk 'em, like fast talk them. You're just working with them. You're easy to communicate with. You know what you're talking about. You know about the location. You know about the project. To the extent that you can figure all those things out and effectively communicate what you're trying to do, again, the circle drill, where you're coming from, where you're going, why you're going there, what changes for you when you get there. You map out that circle drill and then you map out the things that I just mentioned. To the extent that you can do all that, you become a logical player. And when it's logical to work with someone, then it's very easy for them to want to give you deals they wouldn't give to other people, like the vendor carrybacks or the owner contracts. I have capital, but not much time. Do you ever consider partnering up with a capital partner? And if not, what do you recommend people in my situation do? We are open to a capital partner, but understand that until we really know who you are, like we're gonna have to grab coffee. So if you're not in our market, you're gonna have to fly over here, or we'll have to meet with you when you're in your market. We have more deals than we have money. It's the opposite problem of everybody else, but we always find the money because if you find the deal and the debt, and it's a great product, both on the deal and the debt, it's really easy to find the money. So if you'd like to do something like that, you can reach out. We can grab coffee, but we will 100% have a buyout agreement in there. You don't get to ride it with us forever. and you'll have equity based on what you would put in on something like that. But note that if you're putting in money with anybody, they should be an open book on their finances. So you asked about what do you recommend people do in your situation? If you're going to put money with anybody, you need to have a full understanding of their real estate schedule. And more important than that, their debt schedule. They should be able to show you every debt product when it's due. And you should be able to do the math based on the income that that asset can produce, the logical expenses that it'll have, and then the debt. And then you have to look at the risk of when their debt's due. If you're looking at putting money with people and they won't show you those things, or they're not going to show you parts of those things, like when the debt is due or what the payments are, or the AM schedule, or they're trying to hide debts, then you shouldn't put money with them. But if you find a credible person who can show you all those things, they can show you the deep dive on that project, then yeah, that's something that you could entertain, or someone that doesn't have time could entertain. I wouldn't, if I were in that situation, go with like a super big player because they don't have to give you the best deals. The people that are right in the middle, they have good experience, solid foundation, but they're not super well known, like the Cardones of the world, like the billionaire plus. Like the Cardone doesn't have to offer you a crazy return. The newer fish that know exactly what they're doing, that have been doing it for a period of time, they're offering higher returns because they don't have that name yet. So that's what I would do in that situation, but totally up for you to look into. Can you run through how cold call structures are like and what to say? Absolutely. So if you're calling a broker and you're calling them on a deal, again, everything comes down to what's your objective. So my objective is to build a relationship, and that's the foundation of whether I'm calling a broker or owner. When I'm calling a broker, though, I'm calling them because they have a specific deal. So I'm always going to start the call with, is it available? And the reason I ask that is I don't want to get through my call and then they say, well, actually, this is under contract. Sorry. And that'll take the wind out of my sails. I don't really want that. I don't want to start over and dig out of that hole. So is it available? I'm going to jump into the location. If I have an understanding of that market, I will let them know that at this point, but I'm a little unfamiliar with the location of their listing. And I'll always say that because typically that's true, especially when I'm jumping into newer markets. Even if I own there, I may not own in that specific neighborhood. So I want to ask them their thoughts on it. And you can go into questions about the bankability, but really what I want to outline in just a few quick questions is that I know what I'm doing, I don't waste breath, and I am looking to become a bigger player in the market. And if they're a solid broker, when you wrap up that call and you ask, is there anything else I should know about before making a decision on this deal? Typically, they're going to propose a better opportunity. And if you want to reword that in a different way when you're wrapping up the phone call with your broker, is this the deal that you would want to start our relationship on? Because if it's not great and there's something they're not telling you about, if you present yourself as an expert, if there's something better that they know about, they will tell you at that point. If you're calling an owner, you're just identifying a couple things. You're identifying that they've done something you've never done. You're sharing a relatable point because relatable points build interest in getting to the table and actually meeting up over coffee. My objective with them is to meet up and build that relationship. So I have to acknowledge they've done something. Hey, I saw you on a 12-plex in Marina Drive. I haven't bought anything in Moses Lake. I bought a 12-plex in Quincy, trying to learn how to get in the market over here. Saw you did this. Could we grab coffee? That established that I've done the real estate game a little bit. Or if you don't have a 12-plex in Quincy, then you say, hey, look, I'm trying to get into the game. Haven't met anybody that's done this before. And then you try and push for that coffee meeting. And then you get off the phone. But it's a short call. And if they're not interested, then you call them back. I've had people hang up on me before, and I've still bought real estate from them. I just had to call them back later when I thought about them. It's not like I have them on a CRM or schedule. I've never done that, but I do call them when I think about them and just keep in touch. And you ask for a coffee meeting enough times, enough different ways, and eventually your odds of getting one are pretty good. When I'm raising my down payment, would I raise reposition cost and reserves at the same time? So I'm assuming that you're talking about your closing costs there. Yeah, if you are raising money and you don't have any money, then you do have to pay your bills. So it would be wise to make sure you can actually pay for all the closing costs. And if you have reserves, that's good. So, I mean, I would opt to have those reserves. So if you need to raise them, great. But you can also structure your debt where it gives you those built-in reserves. You could do a clause like Caleb does, a Hummel hack, where you do no payments and no accrual of interest for X amount of months. And if you have no mortgages, it's easy to save up a reserve. So you can either do it with your investors or you can do it with your debt, but you can get creative on that on the back end. Okay. If the network is very small, but I find an amazing deal, where do you go? Well, you go to places like this. You go on lives. You ask questions about the specific deal. You don't need to go into the specifics on the actual address, but you can share what you're looking for and ask to connect with people on the live. There's 26 people on this live right now, and one of them likely has capital that could help assist you with your deal. It's not going to happen until you build a relationship with them. So that's where you can connect. You can exchange phone numbers, sync up on Instagram or Facebook. And I know we've connected on Instagram before, but that's where you can ask for people's numbers, try and meet up with them, grab coffee, learn about their story, start building that actual relationship, maybe make some friends out of it. And you can work on the deal with people. Like the people have what you want, which is money or deals or you know, time. People can spend time with you if you want that. But whatever you need, somebody has. So you connect with people and stuff like this. How do you cover agent fees if you're going zero down? Well, if it's 100% finance from the seller, then either you're gonna have to write a check or the seller's gonna have to write a check, but the money has to come from somewhere. You can buy deals zero down out of your pocket, where you're borrowing the down payment or bringing in a partner. I like to borrow it over bringing in a partner every time, but up to you. And then that money would typically pay a percentage to the agent, and I'd go through escrow, and that'd be a seller expense on their HUD statement. I'm 19 and have been watching for 2 years now. Just wondering if you have any advice how I could find a good mentor. Yeah, I actually have a section on my YouTube channel, and now our YouTube channel, Christian's just not here. But when I started, I actually made a how to find your miracle mentor. And I think that's still on the page because I haven't taken videos down. But I would start checking that out. And really, you need to find people that can align with where you're going. They understand where you're coming from and what changes. It's again, it's a circle drill. What changes for you when you get there? Everything we do is so simple. It becomes repeatable. It all works together. But watch our video on the circle drill, and then what you want to do is map out that of others. And when you find someone whose circle matches with yours, they are a likely candidate to be your mentor. Rob has arrived. Welcome, Rob. The only problem I have from D-Storm is that their price doesn't work, but you're asking them to sell their finance. I thought give them price and you get terms. How do you handle a situation like that? Well, I'm doing a deal right now and they want price and terms where they're getting cashed out and they want their price. Well, what happens? They never sold. That's just a 1031 buyer that'll pick up that property. Not every deal is going to work. That's why there's a lot of them and they're on Google Maps. But, not every situation will work out for seller financing or real estate contracts or getting creative. You can always get creative, but to the extent that that will actually work out for every deal varies. That's why simplicity matters. As soon as you know it's not going to play out, you can say, "Hey, great, let me know if anything changes. I'm still highly interested, would love to put together." But then you move on. You don't have enough time to waste on one deal when there's 100 of them like it on the same street. Just move on. If you had $1,000,000, uh, where do you find people to invest with? Well, I would find the players in the market. It's the same with when you wanna find, properties. The most knowledgeable people in any given real estate market are the people that own all the real estate that you want to own. So I would call the like our Google Maps method, how to find any property owner ever. We have a video, it's like 8.5 minutes on our YouTube channel. Check it out. But that is how I would find people to put it with. If you want to buy in that market, figure out who owns all the real estate in that market. Call them up, grab coffee. Don't flex that you got a million liquid. You don't need to show all your cards. But you can say, hey, look, I'm looking to get into the game. I've got some money saved up. I saw you're a player here, and I'd like to connect with you and try and grab coffee. Same exact way as I'd find an owner finance deal. Hey, Cody, it's Ryan from the New Jersey meetup. Hey, Ryan, what's up? Curious on your thoughts how to structure a zero down deal for a 70 unit where the owner owns it outright, listed at $12.75 million. Total income is $990,000. Expenses are 400,000. Units are classic and needs updating. Market income. So you got is 1,350,000. Okay. So you got some upside. You got half a million. No, you get sorry, $600,000 of net income on a almost $13 million deal. So you're a sub 5% cap rate, meaning that your dividends, if you paid cash, would be just below 5%. And I took the net income divided by the purchase price, and that's how I came up with that number in my head. That is less than half, less than 5%. So your total cost of capital, meaning the debt that you structure on that deal, is it needs to be less than your actual dividends. So if we get the exact number and we take the 590,000 NOI divided by $12.75 million, you have a 4.63% cap rate, meaning the dividends on that deal before your taxes go up is 4.63%. What you're going to have to do is make sure that you borrow money cheaper than 4.63%. So I would opt to do some type of interest only debt for a long period of time, 10 years plus, if I was going to buy that deal. And I would want it to be probably between 3 and 4% so I can make a spread on that debt. Then any down payment, you'll make the 4.63% dividend on your down because that's your cash. You're paying cash for that portion of the deal. And then you'll earn margin on the rest of the debt. Owner doesn't want to carry a contract, but would be open if it's more than asking. Yeah, so you just figure out what is the dividends you'd get in relationship to the price, so your cap rate expressed as a percentage. That is what it is. It's just your dividends expressed as a percentage. If you paid 14 million for the asset, it's probably not worth it. If you paid 14 million for it, if your NOI is 590, we just do the same exact math. We take 590 on a calculator divided by 14. You have a 4.2 cap. If you did 100% financed on that deal, 3% IO for 10 years, you're going to make 1.2% spread on the debt. And 1.2% spread on a $14 million deal times 1, 2 is $168,000 a year in cash flow. That would be a great deal for you. It'd be a great deal for them, but it depends. So it depends what you want to do with it. If they're willing to hold a contract, if you pay more, go for it. But again, price is only an issue in the absence of value. If you don't have enough value to justify overpaying by that much, then you shouldn't do it. Hey, Cody, sorry if this was asked already. How would you structure a deal with a private money lender in terms of interest rates and whether or not you'd want them to fund the property or the down payment? I like to fund it as debt, which is just going to be a lien, aka a loan, and I like to put it against title. So they'd be in second position as a standard. I have backed loans with companies before and then paid them off or refinance them and put them on the real estate. But you put it against your real estate as a standard, just as a lien. You can also do it as a equity partner with some sort of buyout agreement that your attorney would draft up. But I prefer to put it as second lien against the real estate. That's 100% up to you how you'd like to do it. The interest rate is irrelevant. You just have to make sure that you have long-term fixed rate debt and cash flow with margin. It could be 12%, could be 7, could be 2. There are deals that you could borrow 12% money that would cash flow more than deals where you would cash flow 2% because of the dividends that it would produce. So it's very deal specific. How do you raise down payments on seller finance deal without investors? Do you use hard money lenders? Well, they would be an investor at that point. If you're looking at an investor, like they are investing something into you or with you, whether it's money or time. If they're giving you money, it could be as a partner where they're an actual investor in the deal, but they're investing in something if they're lending you the money. They believe that they're going to give you something and they're going to get something back. So if I mean, it could be a hard money lender that would take second position. I've seen a lot of those come out of the woodworks recently. There used to only be a couple, and now there's a lot more. but they are still investing into your deal. They're taking a vested interest against the asset, and they expect to be paid back. But I found the best debt products to be with just individuals. The bigger the company, the less likely they are to want to get super creative. How do you invest out of state if you can't see the property in person? Do you hire an inspector? Well, yes, you hire an inspector, but you also have to figure out how to go see that property. I have a friend who posts on their socials about how they lost money on deals that they did not go see. And I was like, go figure. Imagine that. You should go see your real estate. You should not just believe that they're going to be in your best interest because why would they? You haven't met them before. You need trusted boots on the ground if you're investing out of state. You don't have to have that right away. You need to build that out. And you should go see the asset yourself. That is just a non-negotiable for us. What do you think of leasing a property from the seller with option to buy? Owner wants price, location needs capex, and lease up to use the strategy. Anything you would caution or consider? I am not a huge fan of lease option. If you're going to do lease option, just do a real estate contract. That's my thought. There are plays for it, but again, just because you can doesn't mean you should. And just because it makes sense doesn't mean it'll make money. Lease options make a lot of sense. I learned about lease options through Carlton Sheets. It's an audiobook. I'd plug and play in my 1991 Miata before it got stolen. But I'd drive that over the mountains to go look at properties and then drive all the way back. I'd be listening to this on lease options and creative finance, real estate contracts, so the whole lot. He's one of the OGs in this space. And very, very cool concept, and a lot of people I know are doing it, but at the end of the day, you don't make a ton of money typically doing that because 'cause you're not gonna do that on a huge apartment deal. That's not realistic. You can do it on a little like residential properties, but on the stuff that we wanna buy, we just don't see it often enough. They're gonna do a real estate contract more likely in that situation. So, yeah, I would, make sure you mentioned caution. I'd have some clause in there where they can't further encumber the asset while you're leasing it, but, I can't speak to it a bunch because I don't do it. Financial firefighter. Aloha from Hawaii. Aloha. Alright. What type of returns what type of return do you look at getting for renovations? Well, if I'm doing a reno, I'd like to get a higher rent because I'm gonna spend a bunch of money, make it way nicer, but usually the biggest ROI is that if I renovate the whole asset on a commercial level, my cap rate goes down, and cap rate Eh, there's an inverse relationship between that and price. So the lower the cap rate goes, the higher the price goes. And the way you lower your cap rate as a standard is you make something more stable and you increase the quality of the asset. Cap rates are cash on cash return if you pay cash. That's it. People have all these different calculations for how they come up with their values, but if you pay a higher price, you're getting a lower return. So that is how that works. And so if I could push that return down for the next person, my value in turn goes up. And the way I do that is I stabilize the asset and I optimize the asset. So I make it much nicer in quality and I get long-term fixed rate leases. Okay. Are you going to seller finance the Batman building in Nash? Might just have to do that. I don't know that I have that in the budget quite yet, but maybe tomorrow. Can you touch on your strategy on mitigating the risk of balloon payments? Absolutely. So if they do a 5-year deal, 5-year balloon, you're asking how confident are you that you can refinance? Well, I'm not 100% confident. That's why I don't like 5-year debts. So if I'm going to do that, it's going to be a low enough dollar amount that I can just write a check for out of cash flow, or I will have an option to extend it for a fee, and then I'll make sure that my cash flow can pay for that fee and then some. How do you stabilize the asset personally? Well, you do it with a team. So instead of personally, it's more business. But you're getting long-term leases. You're mitigating your capital expenditures, and you're pushing really stabilization period is just pushing towards consistency. You want consistent income, consistent expenses, and you don't want any impending balloons. If you can get those things, life gets a lot easier. So you have to work with your team, or if you're doing it on your own, you have to work with your attorney and work with your tenants, really, to get them into a 12-month lease with, it doesn't have to be market rent, but it has to be consistent rent. They need to be making their payments. And you need to make sure they don't have any huge leaks that are just wrecking your asset or increasing your utility bills. You need to solidify your expenses. Would you see the property before due diligence period or during it? I like to do it during. However, on almost every deal that I've written up, I've driven it before, just in passing. At least I've seen it. I haven't been inside, but typically I'll drive the outside before and the inside during. And with that, we are out of questions. One follow-up on that last question, though. They were asking about the out of state. If I can just see a picture of it and a little video walk around before I go visit an out of state deal, absolutely. But I will definitely go inside the asset during due diligence. What do you mean lowering the cap rate? Isn't the bank just going to loan you money on current rates? So cap rate's not your interest rate. You've got your loan interest rate in one hand, which is the interest that you're paying on the money you borrow. Cap rate is your cash on cash return when you pay cash, and you pay cash for every deal. The problem is it's not your cash. So there's an associated cost, which is your loan, and you can measure that with the loan factor rate. But your cap rate, if you buy $1 million deal, and at the end of the year, the net operating income, which is your gross income, less your actual expenses. So if you had like maybe 140,000 in income on that $1 million deal and 60,000 in expenses, then you have 80,000 NOI. 80,000 net operating income on a $1 million deal, that 80,000 would be cash flow if you were to check for it. So if you bought it for a million, and you put 80 in your pocket, it's an 8% return, 8% cap rate. If I push that percentage down, if I sold it to the next person, the same $80,000 of net operating income on a 6% return, I'm just doing this on my calculator. That would put the value at 1,000,003. I'd make 300 grand out of thin air. So I want to push that return down for the next person because that pushes my value up. Whether I sell it or not, my asset is worth more if it is nicer and more stable. And with that, we are rounding the hour and our questions. Appreciate everybody jumping on. And as always, we will see you next week. All right, top 5 favorite books. I'll give you a couple, and they're not all books. Some of them are audiobooks. Um, I just read a book, The Art of War. That's really cool for negotiation. I like Deals on Wheels by Lonnie Scruggs. That's a all-time favorite real estate book. Cardone has a book, 10X Rule. That is phenomenal. And buying, I don't know the exact quote. It's Buying Money Low to No Money Down with Carlton Sheets. He has an audiobook that is older, but I would check that out. And then a fifth one, Rich Dad, Poor Dad. Everybody says that, but that little purple book helped me get started. Do you recommend any websites or sources when looking for properties? I use Google Maps. And are you buying in Clarksville? I'm not buying in Clarksville. My girlfriend lives here. She's awesome. I'm in her house right now. But she's got some rentals here, as do some of my friends. And they found that there is still a huge opportunity to cash flow and get appreciation. With that, I'll see everybody next week.